Cheese and butter may be looking grim, but whey continues to be dairy's shining star as we head into 2026. We're talking market movements and where the opportunities may lie with Curtis Bosma from HighGround Dairy today on the Uplevel Dairy Podcast. The information shared in this podcast is for educational purposes and is not a solicitation to buy or sell commodities. Opinions expressed are current as of December 17th, 2025 at 12:30 p.m. Central Standard Time and only represent the views of the speaker and not those of HighGround Trading unless otherwise expressly noted. This episode is brought to you by HighGround Dairy. HighGround Dairy provides global dairy market intelligence, insurance services, futures and options brokerage, and advisory programs to a diverse range of dairy market participants throughout the supply chain. Curtis, welcome back to the Uplevel Dairy Podcast. It's December, so give us the update. What's been going on for the last month?
Well, I wish I had some better news to report on. Dairy prices have been stagnant over the last month, but we're really not seeing much of a recovery from where we're at. Because spot prices remain at some historically low levels, we're seeing futures come off, particularly on the Class 4 side of things. You got the first quarter of 2026 trading below $14 a hundredweight now. But on the Class 3 side of things, dry whey has been our thing keeping the curve afloat a little bit. We still have our block cheese price that's in that $1.40-ish range, which would normally translate to a Class 3 milk price closer to $14. But because of that additional dry whey value that's still hanging out there in some of those higher price points, we are still looking at Class 3 futures in the upper 15s. And even when you look out into the back half of 2026, we're in the mid $17 range at the moment.
So not the brightest news on the milk side, but there are some areas we can look at for a little bit of optimism.
We look at our core 4 dairy commodities on the cheese and butter side of things, not too many bright spots. Cheese has continued to drag near some of these historic lows, which has weighed on Class 3 futures and continues to press on some of those things. But again, the whey stream has added a ton of value there. Butter production has been through the roof. I know we've talked about increased component production, that when we had higher butterfat prices, it was a race from both a genetics and nutrition standpoint to say, hey, how can we make this as efficient as possible? And like always, the American dairy farmer, you can never bet against them. They will always do everything they can to make milk as efficiently as possible. So it's always amazing how quickly people can respond to those types of market conditions. But now we've put ourselves in a little bit of a scenario where maybe we're a little too oversupplied on some of those key things like that.
Let's shift over and look at milk production and some of those numbers that are coming through in U.S. supply. What are you seeing there?
Yeah, so with the government reopened now, we're starting to get data showing back up again. We've got a number of reports. We even got a double whammy earlier this week of 2 months worth of data in one day. But looking here, our most recent milk production numbers in the U.S. to look at for October 2025, we're still showing pretty significant growth. That we've had now 5 consecutive months of at least 3% year-over-year gains. Again, some of the big growth we're seeing out of the upper Midwest, but in particular, the 2 states that really stand out when you look at the map are Idaho being up over 100 million pounds year over year, and California being up 221 million pounds versus last year. Again, October data, we had some cases of bird flu starting to affect milk production in California for October. We're going to see probably even more of a dramatic year-over-year change in the November data. But it seems like every producer we talk to, whether it's out here in California or in the Midwest or the Northeast, everyone seems to be just talking about how amazing their efficiency has been and how great milk output is. But unfortunately, we know that with increased efficiency and with all of that extra milk output, it's put us in a bit of softer market conditions here moving forward.
And Curtis, you just touched on the bird flu impacts from 2024 in California. Well, recent news in Wisconsin, we just finally had our first herd test positive, and that came out in the news over this past weekend. Have you seen any reaction in the marketplace to that news or heard any murmurings of fear related to that and what it could mean for another large milk producing region?
When those headlines first came across about herds in Wisconsin being impacted, I think we all took a deep breath and said, okay, well, what's this going to spell for the next month or two here? At least from some of the chatter that we're seeing, I don't know if it's going to have much of a major market impact in the near term. I think a lot of that is just due to where we're at on the calendar seasonally. If we think of when the impacts really started in 2024 for regions that were impacted by bird flu from a production standpoint, it was a little bit earlier, started in late Q1, early Q2 in Texas and other regions, and then we really had it hit California and Idaho and other regions towards the middle and later part of the year. But we were really seeing the strongest impact on milk production around that peak holiday demand season. Whereas now, if we're to see milk production taper lower in December or January as an impact of what's happening, it won't have as much of an impact on market prices at the moment, but it still is something to monitor because as we know, these things can spread. The other thing to watch with all this, and I'm sure there's vets and other industry professionals that are way more well-versed in this, is just how strong the cases are. Because I know initially when people got the first wave of bird flu, milk production losses were 30, 40, 50% almost overnight. And it seems like there's been some recent cases that we've heard of in Arizona and other regions where the milk impact hasn't been as severe. So I don't know if that's a mutation of the original strain of bird flu that, is weaker, or if there's some herd immunity or something like that. Again, I'm sure there's people that are far more qualified to comment on the scientific side of that. But from a market impact standpoint, again, we're monitoring it closely. And if it does really start to pull back on milk supply, it will be something that if it really caps the ability for us to see a strong flush, then we'll have something to talk about.
So you're not seeing a strong market reaction yet, but still monitoring closely what this could mean, especially as we get into 2026.
Absolutely. I mean, I think at the end of the day, we still have a lot of milk out there. If things were to tighten up a little bit, it would probably be healthy for our overall dairy balance sheet as a country. But nobody wants to be on the losing end when it comes to production losses. So
let's pivot over to some of the other market highlights. What else are you seeing in some of the movements and paying attention to in the markets right now?
Yeah, so we had a period of time there when looking at the cheese market where we moved up. We had some little holiday support that kept our cheese prices kind of buoyant in that mid 170 range. But of course, we've now softened down into the 140s, even 130s here as of late, which is on the one hand is going to put a little pressure on that front month class 3 futures contracts. But on the other side of it is we have now moved back into an area where we are discounted compared to the rest of the world. There was about a 2-month span there where because of us seeing some of those increased holiday activity around purchasing, we were not as competitive from an export standpoint. So that's, I guess, one bright spot to look at going into 2026 is that we may continue to see some of the export business pick up again. Another thing, we're hearing a lot of chatter among our clients and people across the supply chain about just when prices get this low in general for a commodity like cheese, you'll see a lot of people stocking up on physical inventories to pre-buy what they can to sit on. And that is somewhat of a good thing to make sure that prices don't continue to fall further from where they're at. But that's something to be mindful of as if end users are stocking up on their 2026 needs early in the year or even right now. That could be interesting when we get later in the year. Even if we do have a response in milk production, there may not be as aggressive of an attitude towards purchasing because of inventories that people have on hand. And also, I think something to keep in mind is just general functions of the cheese market. We price off of a 4 to 30-day-old cheddar block market. But when prices get low like this, we see a lot of specialty cheese manufacturers that would, like to place a lot of cheese into aging programs or more specialty cheeses, that when prices get low, it's much more advantageous for them to do so because their milk input cost has come down enough to where they can do that at a better margin. So I think there's going to be some of those factors at play and some things to pay attention specific to the cheese side of things. On butter, again, it's just butter exports have been strong because we have been continue to be discounted. We do make a different spec of butter versus the rest of the world, so we don't typically have as strong of exports compared to other commodities. But still, something to be mindful of is when we are at these low price levels, we are seeing that. But I think it's also important for everyone to be mindful of the butter market for the CME. So like we mentioned earlier, the cheese we trade off of a 4 to 30-day-old block market. The butter has interesting rules where there is like a new crop, old crop date. So typically towards the end of the year in January and February, anything that is of an older make date that may be sitting around that needs to get converted into cash or sold from a manufacturer can be moved pretty quickly. So we typically see pretty heavy volumes of butter trading at the CME. And I think that's going to be something to be mindful of here is, will there be enough appetite or end users, like we're saying for cheese, with a similar mindset for butter, saying, hey, this is at a good value and we're willing to take ownership of product at these price levels. So yeah, it's going to be an interesting little volatile period here over the next couple months. Unfortunately, we're in a situation where prices are relatively low for those two key commodities that feed our milk checks, but there are some bright spots. So it's not all bad news. I think the main thing to touch on there is just dry whey. Again, it seems like the high protein demand at all the recent industry conferences, it's just nonstop chatter about how there is insatiable demand for these high protein whey derivatives. The product development from the retail space of new products that are going to have some form of whey protein in them has been tremendous. So caps off to everybody involved that's been really pushing for those new products and such. But as a result, it's drawing that commodity grade or that lower protein percentage dry whey up in price as we're pulling on everything else. So it's helping to translate to a class 3 price that, if you look at the cheese situation, we should have a much lower class 3 price, but because of whey, we're still hanging on to some decent values here.
Thank goodness for whey, huh?
Yeah, it's kind of the unsung hero. It was one of the 4 commodities that we often forget about, but it seems to be the saving grace going into 2026.
Yeah, well, thank goodness for that and for some black-hided calves as well, huh?
Yeah, I think alternative revenue sources for dairy farms have been critical, especially I think in the fourth quarter of 2025. But as we go into 2026, looking at margins, we've had a lot of interest from producers that have maybe not been as proactive on managing their risk on the milk side of things, that have been reaching out and running the numbers and saying, hey, I'm making $4 to $5 a hundredweight on a milk basis from my beef revenue stream. And with all the volatility we've seen in that feeder market and the live cattle market, what's going to happen with that? So obviously there's some political influence there. We've discussed that in October. The Trump administration made it kind of known that they're looking to lower beef prices for the consumer, which sent shockwaves of what is that going to mean? Are we bringing in cattle from South America or Mexico to kind of replenish our cattle supply here domestically? Lots of rumors swirling on how government may or may not intervene in that market. I think at the end of the day, we still have a relatively tight U.S. domestic cattle inventory. So that's kind of kept things buoyant, because ultimately that feeder cattle index, which settles to actual data from the auctions across the U.S. for those higher weight steers, those prices really haven't flinched all that much. So we're still holding on to some pretty good values. But yeah, when you look at a dairy operation, you're looking at those alternative revenue sources. I mean, $4 to $5 a hundredweight from the beef stream is significant. It's also interesting kind of talking with some producers, and I think it really depends on the size and scale of the operation you're dealing with, but there's a lot of revenue sources even beyond just beef that are becoming more and more significant. If we think about methane digesters and solar and other things that people can do, talking with some producers, we're getting into the $7, $8 a hundredweight of non-milk revenue that can really tie into an overall income statement for a dairy farm. And I guess the bright spot of that is it helps keep cash flow stable for dairy producers that can tap into those revenue streams. But the scary thing is looking at milk prices going into 2026, when we're getting into some of these sub $14 prices like we're seeing in class 4, we would think that would translate to potential contraction of milk supply in the U.S. But if you're talking about facilities or larger herds that have the ability to generate all of that additional non-milk revenue, we're not going to see much of a cash flow crunch on those types of operations until we're at $12 per hundredweight or lower on a milk price. Mm-hmm. So that's just something to be mindful of looking ahead. I think you never want to play the game of, as long as I can do slightly better than my neighbor, I'll be okay. You kind of want to make sure that you're always kind of controlling your own destiny, your own legacy. But it's in a situation now where milk prices would likely have to get very low to see a significant contraction of milk supply, just given the power of these alternate revenue sources on the dairy farm.
So, Curtis, kind of summarizing all of these points that you've laid out here, what does that really mean as we look into 2026 and where those margins are at? And what do we do?
Looking at 2026, margins are depressed for, I would say, the first two quarters, but there is still some value to be derived. So we've been looking into covering a lot of that beef revenue through different various tools, whether that's through like LRP coverage or using futures and options to mitigate some of that price risk relative to that beef stream. So that's been somewhat helpful there for, I would say, the first and second quarter. If you're in a region that has a bit more of class 3 influence, so upper Midwest, I-29, the class 3 market in the second half of 2026 is trading at a pretty significant premium to the spot market right now. And so if you're looking at it holistically of like, okay, where class 3 is at for the second half of 2026, where my projected beef revenue is at for that same time frame as well, and with feed costs being at a historically cheap level, the numbers still make sense and still pencil in a lot of cases. I think a lot of people maybe get hung up on, well, it's not good now, it has to get better later, and it's all going to average out in the end. But there really is no guarantee to that, especially when we're talking about some of these alternative market forces. We've never really had a market condition where there was a revenue source other than milk for a dairy farm that could impact the outcome for everyone. And now we have some very viable options for creating revenue at the dairy farms that could really spell trouble if people aren't addressing margin management proactively.
So, Curtis, in summary, taking everything that you've laid out for us today, if you were to really take that and put it into a playbook for what are the next steps for dairy producers heading into 2026, how would you lay out those next steps?
Yeah, so on the milk side and on the beef side, really just picking your spots and staggering in. We've seen some nice upward movement the last couple of days in the feeder cattle market, which has led to us getting some good coverage on for folks looking at some of the stuff further out in 2026. And then also on the milk side, like I mentioned earlier, class 3 still holding on to some decent premiums in the second half of 2026. So picking your spots, not getting overly aggressive out there, but making sure that we have some coverage in place just to reduce that exposure overall. And I think in the next chapter of the playbook is either you got to look at feed, you got to look at the total margin, depending on where you're at and how the basis levels are looking around you for some of those core commodities that you're buying in, staying proactive on those things. And whether it makes sense to get a basis contract or to do something priced on futures or something like that, there is a pretty decent carry at the moment from where like spot pricing is for corn and other corn ingredients out to what you're getting quoted for clock contracts or longer term physical contracts. So in a lot of cases, we always rely on other experts in those categories that are helping producers navigate those types of situations. But beyond that, of understanding, okay, if we agree to a clock contract on our corn going out through September, what can we do in the tail end if there is some sort of an erosion in that forward curve? Looking at the balance sheet for corn, we're still in a situation where a large carryout is very possible. We're coming off a big crop. Exports have still been steady, but at the end of the day, we want to make sure everyone has that margin flexibility to capitalize on everything. So I think it's just understanding those options, reaching out, walking through what strategies are available to me. If I lock up feed today, if I lock up beef, what does that look like long term? And when we run those numbers for people, it doesn't look as bad as you may think. Like when you look at class 4 futures right now, you may get a little bit of a sour taste in your mouth, but when you look at the holistic margin, things aren't that terrible.
That's a good message, I think, to end the year on. And so that clear call to action that you want to leave producers with as we round out our conversation today in this December monthly market update is what?
It's late in 2025. I think a lot of people would say, okay, well, we've had a lot of conversations recently where people say, oh, I missed the boat or we're kind of behind the curve on something. And I think it isn't too late. It's kind of my call to arms here is there still is things that we can do. There's actions we can take to protect some of the value against your financial situation going into 2026. There may be some options or some different levers that we pull that we may have to because certain things aren't available at the moment. But it's something we can continue to at least discuss and stay proactive on. I think just making sure everybody is staying in the game and knows that there still is time to plan ahead for 2026.
Excellent. Well, thanks for rounding out our monthly market update here today, Curtis. And hey, this is kind of the send off into the new year as well. I have challenged a lot of people, Curtis, to choose a word to live by in the year ahead. So I'm putting you on the spot. I didn't give you a minute to prepare for this one. So what's your word for 2026?
Survive. Survival is always key. I think we've got a lot of craziness ahead. I think our business has been growing. We've got a lot of exciting opportunities. We've got a 5-month-old at home. Life is busy. So I think survival is key right now. I wish I could say thrive would be my word, but I'm playing a little more defense now with a busy home front and some volatile markets here.
Well, hey, here's to surviving 2026. And I'll take the optimistic route and say that by the end of the year, hopefully you will have shifted survive to thrive. And with that, thanks for rounding out our last monthly market update for the year, Curtis.
Yep, thank you. And Merry Christmas to all the listeners.
All right. Thank you so much. You just listened to the monthly market update from HighGround Dairy with Curtis Bosma here on the Uplevel Dairy Podcast. You can check the link in our show notes to learn more about HighGround Dairy and get in touch with Curtis and his team. Thanks for listening to this episode of the Uplevel Dairy Podcast. Make sure to give this episode a rating, a review, or share it with a friend if you've enjoyed it and found value in this conversation today. I'm Peggy Coffeen, and once again, keep on growing, keep on learning, and up-leveling your dairy.